Now, the European debt crisis may be having a big effect on stocks, although we're little changed right now, looking at almost no change on the Dow and the S&P. Copper, you see there, though, down, what, 5% on the day? Also dropping the most in 3 weeks, that drop. Lincoln Ellis follows commodities closely for the Lynn Group, a Chicago-based clearinghouse that runs commodity-based and global macro hedge funds. He joins us on the floor of the CME. And I want to talk, Lincoln, a little bit about copper as a way to kind of back into the global economy and then eventually get to Europe, because why wouldn't we want to talk about Europe here? What's going on with Dr. Copper?
Well, look, Matt, I think clearly the copper story has been telling you for some time that the global slowdown that we've been talking about for the last 18 months is here. We've seen it emerge in the emerging economies, and that is based on the necessary recalibration of the developed economies' growth rates. And when that happens, you see pieces of the commodity complex that are particularly sensitive to the emerging economies, like copper, where there have been large bids out of China, they come off, and then they come off quite significantly because the exits are quite small.
Do U.S. data points have any effect on copper, or is it all about China for this metal?
It's very much about the emerging economies, but I will say that there is some lack of support there in terms of what happens in the developed economies. We continue to talk about the Obama administration and other people suggesting projects like infrastructure rebuilding, and those continue to get pushed to the side. If we were to undertake some kind of substantial infrastructure projects in the developed economies, that too would put a floor under the bid for copper, because we have a lot of use for it in retooling large portions of Europe and the U.S.
Yeah, I was going to say, you see the opposite going on in Europe, right? Is the austerity having a big effect on the trade?
Well, austerity definitely put a downward pressure on large portions of the commodity complex as we came into the August-September timeframe. Continued fear over what goes on in Europe and the Europeans' inability to get their act together continues to put that downward pressure. Although, if you look over the course of the last 10 days when we've had the equity rally, risk has been added back into the market across various portions of the commodity complex. In particular, you look at the grains, and copper did have a run before today's precipitous sell-off.
Let me ask you about what's going on in Europe, Lincoln. I mean, obviously, it's a very complex situation. None of us has really been able, or at least none of the European leaders seem to have been able to get their heads around it completely, but it's driving markets. I mean, how important is what goes on in Europe for the global economy and for global equity markets?
Well, at the moment, it is the story, and it is what has us transfixed. The possibility of a major liquidity issue hinging on various defaults and the destabilizing effects that would have on the third and fourth largest economies in Europe are what's sort of underneath the cover. Greece is not really a problem. The other parts of the peripheral are certainly dealable with the existing size, levered or unlevered, of the ESFS. But what's lurking behind that is really a deep concern about Spain and Italy. And as our friend David Rosenberg said yesterday on Bloomberg, that there is continued signs of significant weakness across that banking sector, and that could lead to very difficult depression-like conditions in Europe and very deep recessionary conditions in the United States.
Is there a solution there? I was listening to Mike McKee and Sarah Eisen on the economy this morning. They had a professor on from Brown who said basically there's no hope. We saw Italian 10-year yields go up above 6%. Is there any hope here?
Yeah, there's definitely a hope. Look, I mean, you get the ESFS and the European Central Bank to agree to lever the fund either 3 or 4 times to 1. You have to agree on a haircut much deeper and tighter than even your own, Matt. And then you have to really get the banking sector to recapitalize itself and be serious about raising capital to substantial levels at the Basel III level or higher, and that will allay fears. That will put out the fire. It doesn't mean that you get the house rebuilt. As we've talked about many times in the past, It's really about a slower and lower rate of growth across the developed economies that the equity markets in particular, as well as the fixed income markets, have priced in here. There's a solution. It doesn't rebuild, but it definitely stabilizes.
Got it, Lincoln. Thanks so much for joining us. Lincoln Ellis there from the Lynn Group in Chicago.
Thanks,